Welcome to Taking Stock for the week ending 1st of December 2023, the first day of summer, where myself, Tim Lincoln, and Kien Trinh, our head of Stock Doctor Research, stream to you all things share market. Welcome, Kien. How are you today?
It's great to be here, Tim, and I'm very well, thank you. And I can't believe it's already December. You know, the years pass so fast and so many things happened with geopolitical risk, inflation, all that, but we'll talk more about it later.
Yeah, it certainly has been a very, very busy year, hasn't it, in equity markets? But as you say, more on that in a moment. And before we get started, Kien, just a reminder to all of our members, and thank you all so much for tuning in. Hope you're all well, that all of the information we provide today is of a general nature and therefore should not be construed as personal advice. And all of the data, performance metrics, etc., is all historical and therefore should not be relied upon as a guide for future performance. And hopefully our members, Kien, have logged into Stock Doctor during the week, because if they did, they would have seen that we have released a new enhanced home screen for Stock Doctor, and it's providing you with a snapshot of our expert insights, so therefore some articles you'll see at the top of the screen, your portfolio analytics a little bit deeper, including the health of your portfolio. So we've extrapolated out the health of your portfolio in addition to obviously the health of companies. So that's fantastic. And also relevant market movements there in a markets panel that goes even deeper. And if you haven't logged in and seen the new home screen, make sure you do. And be sure to update the stocks in your portfolio manager alerts and watch lists for more streamlined experience. So if you haven't used the portfolio manager yet, and a lot of our newer members may not have, and also set your alerts on stocks that you've got exposed to and set up your watch list and stuff, do that, because you're going to be able to experience updates to those all within this home screen now. So hope you enjoy it. And also the mobile experience is very, very similar. So it allows you to get that quick snapshot, which has been built based on a lot of customer feedback and member feedback as well. So thank you very much. But Kien, we're now in the last month of the calendar year, and boy, as we touched on a moment ago, has it flown by. Markets, though, remain really, really volatile, don't they? The All Ords has rebounded after falling by about 4% in October, and the S&P 500 has rallied about 8.5% in the US, and the NASDAQ jumping around 11%. So a massive rebound in November from a couple of dour months in September and October. But positively too, our star growth stocks and star income stocks perform really, really well with that market rise. So Kien, what's the reason for the market rally? And we'll touch on some of our concerns also in a moment.
Yeah, Tim, we've been speaking about it over the last couple of weeks, but over November, Tim, weaker than expected inflation data led to investor optimism that the US Fed may be done raising rates. In fact, global bond yields, which reflect interest rate expectations, have fallen from its highs. Here in Australia, you have the 10-year Treasury bond rates, which also dropped. And despite the RBA increasing interest rates last month, this suggests that we could be near the end of the tightening cycle. And in fact, the annual CPI to October, that's now fallen to 4.9% below market expectations. So, Tim, does the market rally and the lower inflation change our view of the market?
Oh, it's a good question, Kien, and one that I ask myself every single day. You know, while the market's rallying, you question your current strategy, of course, but that's the psychology of the market, isn't it? And it seems to be right now a big fear of missing out attitude going on amongst the investors. But despite the rally, Kien, and at that really, really strong rally both here and in the US, our view remains the same, where we continue to hedge against significant volatility across our managed funds. We're heeding the advice of Warren Buffett, who quoted, if it doesn't make sense, stay away. And that's exactly what we're doing with hedging 30% of our managed fund portfolios, both here and in the US. And we're still concerned that analysts are too optimistic, Kien, on earnings into calendar year 2024, with the global economy still yet to really digest the most aggressive monetary tightening cycle in history. So although a soft landing is plausible, this scenario is becoming the base case for investors. So we believe this is a classic bear market rally where speculators are all vying at once to pick up the bottom of the market. And these events are too common in history. So we don't want to follow the herd or the crowd into this potential, into this fear of missing out trap. We won't follow that herd mentality. Consumer spending also, Kien, is down, insolvencies are rising, and risks of an economic contraction remain high heading into 2024. Hence, we will continue to implement our risk mitigation strategies or our hedging strategy across our managed funds until the outlook improves or until risk assets are adequately priced in the economic uncertainty ahead of us.
Yeah, good rationale there, Tim. And I guess this is why sticking to those high quality stocks in the current market environment is so important. Investors may be emboldened just this week by financially distressed pathology business, Helios, when they rallied following their equity raising. But it only takes time before things can go wrong, Tim. And take, for example, another financially distressed business this week, email payments. They dropped by 30% after releasing an operational update below market expectations. In addition, the company's been weighed down by significant cash burn and also ongoing anti-money laundering compliance issues.
Yep. You've got to always have your eyes wide open, don't you? And that's the beauty of Stock Doctor, to highlight those risky stocks and stay away because, shocks, especially in this environment, may not be too far away. And Kien, that emphasises, doesn't it, the importance of sticking with high quality businesses with solid cash flows and also have that really wide net profit margin and strong return on equity should be part of anyone's stock selection process. And obviously that's all part of our Golden Rule 2 and Golden Rule 3 criteria. And this methodology and philosophies is also central to the investment philosophy of the legendary investor Charlie Munger, who sadly passed away this week, aged 99. In fact, Charlie's philosophy of buying and holding high quality businesses for the long term helped influence Warren Buffett's investment style. And interestingly, before the two legends met, Buffett was more of a traditional value investor. So yeah, but Charlie's philosophy very, very similar to ours, or we can't say that Charlie's taking any of our philosophies on board. It was certainly he adopted them way before us, but they are very, very aligned.
Yeah, that's right, Tim. You know, Munger did teach him that investing in high quality businesses with a history of rewarding shareholders, for example, again, those with high return on equity and strong cash flows will generate solid returns over time. And he did implicate that these businesses are less risky than investing in the next big thing, which tends to be unhealthy companies in the early growth phase.
Yeah, such incredible guidance there. And we are blessed to have received such profound wisdom from an absolute legend. So thank you, Charlie. We're eternally grateful, and rest in peace. But moving on, Kien, onto a few star stock announcements. And feedstock retailer Ridley Corporation provided a trading update at their AGM recently. And Ridley is Australia's leading provider of premium quality, high performance animal feed across both agriculture and aquaculture. So what did we learn, Kien, from the AGM update?
Well, Tim, the company has gained market share through product expansion. Positively, the management stated that there was significant year-on-year growth in the first 4 months of financial year 24, with the market anticipating earnings growth of close to 10%. Animal feed volumes have continued to grow, and that's been helped by stronger customer demand for animal feed due to drier weather conditions.
Very, very good, Kien. Now let's focus on corporate software provider Technology One. Great business. Been a great business, really good to our members for a long, long time. So thank you, Technology One. They reported another really solid set of results and brought forward their target annual recurring revenue due to low customer churn and new contract wins, Kien. And however, we did remove them as a star growth stock. So what are the reasons for why we had to remove them, Kien?
Unfortunately, Tim, the key performance metric we look at, the return on equity, that fell from 43% in first half 23 to 38% in financial year 23. And that's crossed our threshold. So that drop in return on equity was mainly due to an increase in the equity base, indicating that there's less efficient use of shareholder capital. And this is also forecasted to decline further in financial year 25. On top of this, Tim, the share price appears fully valued at these levels, with the stock also trading at a forward PE multiple of around 43 times. Despite this, though, Technology One remains a top-tier business with growing recurring revenue, high profit margins, and strong cash flows. So we'll keep an eye on them and consider reinstating coverage when the risk-reward balance improves. Now, looking ahead to the corporate calendar, it's going to be a relatively quiet week in the corporate calendar. So there's really no star stock expected to announce updates, but we will continue to, update commentary wherever we see fit.
And now to Under the Microscope, Kien. And this week we take a close look at electronic equipment distributor IPD Group Limited, or their code is IPG. And Kien, IPD announced last week that it would acquire CMI Electrical, turning the group into one of Australia's largest distributors of cables and plugs. And before we get into the reasons behind this acquisition, Kien, can you provide us with a quick recap on IPG's competitive advantage?
Yeah, Tim, IPG's products are extensive and span from electric vehicle chargers to high voltage electrical services, including the recent addition of cables and plugs from CMI Electrical. And this provides them with significant scale as a distributor of these products, allowing them to improve access to suppliers and maintain cost advantages for customers. That's why they've got such high margins.
Okay, indeed. And their market position is very, very strong, which is great. And the acquisition of CMI Electrical appears to have been a strategic decision, Kien, and represents about a quarter of the market capitalisation of IPD Group. So quite a large acquisition. The complementary nature of the businesses could lead to streamlined operations and reduce supplier concentration risks, which is terrific. It also opens up cross-selling opportunities. Fantastic again. But Kien, I suppose the big question then is, will the capital raise dilute shareholder equity and earnings, considering its size?
That's a good point, Tim. The business is raising about 65 million, which is expected to dilute shareholder equity by about 19%. However, the market responded positively, indicating that the acquisition was reasonably priced. This has enabled the business to forecast an extra 30% contribution to its annual earnings. And this should more than offset that dilution and lead to higher return on equity and net profit margins over time.
Yeah, okay. Now let's dig a little bit deeper into its financial health, because often these situations, especially if they're the capital raise or the acquisitions are funded by debt, can put a bit of strain on the balance sheet, and seen a little bit of strain there in this particular situation, Kien, with financial health sitting at satisfactory levels. And the acquisition involved around $40 million of debt, hence why it's putting a bit of strain on that TLTAI ratio. And so do we think that the acquisition could further impact on the balance sheet and the financial health of the company going forward?
Yeah, currently, Tim, the company has very little debt and has a lot of cash on its balance sheet. So the combined group after this acquisition should only have a net debt of around 19 million, a fraction of the company's total assets at 140 million. In addition, you've got improving cash flows on the back of this acquisition, and this should offset the extra liability. Hence, we believe the company will continue to pass our financial health standard.
Okay, great to know that there's a margin of safety there, which is really important. Thank you for that. And Stock Doctor members who held IPG shares prior to the capital raise eligible to subscribe to new shares at $3.93 each, which is a nice discount to where the current share price is trading, which covers that dilution effect of the acquisition on share price. And it would probably make sense for members to subscribe to the offer, which ends on the 14th of December. And now to question of the week, Kien, and we've just spoken about electrical product distributor and Star Growth Stock IPD Group, which is an average daily liquidity of under Golden Rule 6 of $432,000 traded every day. So a helpful question for investors is, Kien, how do you know whether a stock has enough liquidity to enable a smooth transaction when buying and selling shares?
Well, Tim, under Golden Rule 6, as you mentioned, liquidity basically means how easily and quickly can a stock be sold or bought without significantly impacting its share price. When you've got high liquidity, that occurs when there is a lot of trading activity, making it easier to find a buyer or seller. But when there are only a few market participants or stock is traded infrequently, then it is said to be illiquid or have very low liquidity. And a lack of liquidity increases the risk that you may have to sell a stock at significantly low prices, or you may be stuck in a losing position for a very long time.
Yeah, exactly, Kien. And members can click on the Golden Rule 6 number there and get an explanation as to some of the thresholds we use around this rule, but briefly explain it now as well anyway. And our rule of thumb is to look for stocks with an average daily volume traded figure that is at least 5 times your exposure level. So with IPD Group, for example, the average daily traded volume is $432,000 every day. So you'll be able to trade up to $86,000 shares before liquidity becomes a problem. So that's just a nice little rough rule of thumb, that 5 times your exposure level. So to ensure you don't get left with a falling dagger, especially if the stock price starts to tumble and you simply can't get out. So really, really important. That's why it's one of our golden rules.
Yeah, and from a liquidity perspective, that's why we cannot cover stocks with lower liquidity, say than less than 200K, Tim, because the cumulative impact from our members' actions is significant enough that it can lead to share price moves of up to about 10% on the day.
Yeah, well, with 3,700 members trying to buy some of our smaller cap, more liquid stocks, yeah, that does create a bit of a problem at times, or it can. That's why we got that 200K liquidity threshold. Great stuff, Kien. However, the benefit of Stock Doctor is that it allows members to find hidden gems also, which is really, really important. There's been some rippers over the years, and also emerging opportunities before they become mainstream. So you can screen for these opportunities using our filter tool. Look for financially healthy businesses with strong return on equity, wide net profit margins, and solid cash flows that are trading with lower liquidity than usual. So perhaps look for our normal criteria for star stocks, but lower the liquidity threshold so you can find some of those hidden gems. Or even run one of my filters, say the growth stocks with potential filter, and they pop up in there as well, but make sure you drill into them all. But this is where it's important to understand how much exposure you should take to a particular stock relative to the size of your portfolio. So that also needs to come into play. Good stuff, Kien. Well, that's all we've really got time for today. Action-packed, hopefully entertaining about a content in taking stock today. So always wonderful sitting down having a chat with you. Thanks for your contribution, Kien.
Likewise, Tim, and yeah, look forward to writing more insights for our members with the new homepage.
Yeah, hopefully our members really enjoy the new homepage and all of the insights and regular articles that you and your team will be producing. Just a reminder that on Monday we have Lincoln Live, so look forward to our regulars tuning in. And if you haven't done so, we'd love to have you there. But just a summary on today, rest in peace, Charlie Munger. Thanks a lot for your wisdom and everything you've guided investors around the world with, and also allowing us to learn from your philosophies to incorporate those into Stock Doctor. And his message, his main philosophy is to focus on high quality businesses for which our star stocks are, and businesses that have a really strong track record of generating high returns to shareholders, especially in return on equity, net profit margins, and the like under our golden rule 2 criteria. And of course, are financially healthy. But thank you, everyone. I don't know if December is going to be another roaring month like November was in regard to equity returns, but who knows? It's a crazy market at the moment, and we are in silly season, so who knows what could happen. But take care, everyone, and have a happy, healthy, and prosperous week. Goodbye.